Welcome to a Market Brief special. I'm Caroline Woods, and I'm joined by David Bahnsen, Chief Investment Officer of the Bahnsen Group, for guidance on maneuvering volatility and managing your portfolio. David, appreciate you joining us. Great to have you.
Good to be with you.
All right, so let's start by getting your take on the market and current levels. What's the stock market telling you right now? And given the fundamentals, is it where it should be or getting ahead of itself?
I think in the very short term, it could very well be overbought, but that's very hard to say because you have to compare it to something. And I think that ever since the Fed began supporting the corporate bond market and those spreads narrowed dramatically with yields as low as they are, I do think there's a significant amount of flows that just say large cap US stocks are the best place to be. Fundamentally, though, your question really involves an economic outlook. It requires one to kind of look forward, and that's very much what markets are doing. I'd be on the more optimistic side as to what Q4, Q1, and Q2 of next year are going to look like. I think people are underestimating the resilience of the economy.
David, there's no doubt that the massive amount of fiscal and monetary policy has really propped up the stock market, and hopefully it's doing the same for the economy. But what does getting out of it look like? Do you foresee issues with the Fed and government extricating itself from this?
They're not going to extricate themselves from it. So I see significant issues. They never extricated themselves from the monetary stimulus of the financial crisis. And that's the whole problem. Is I'm very defensive of both fiscal and monetary stimulus in an emergency. The problem is our country no longer uses it only as an emergency. They use it as a status quo, and then they double down it during emergencies. So I think that they will have tremendous problems if they were to try to get off of it. What it would represent, first of all, to the sovereign debt obligations, it's just simply untenable. The debt to GDP ratios are not going to enable them to kind of reverse course. But then, of course, with the credit markets as well. We saw that in the fourth quarter of 2018 with very modest quantitative tightening. The credit markets basically revolted. So I think that we have a longer term issue of what Fed policy is doing. But ironically, it's boosting up risk assets. It's just that, as we've seen in Japan for a couple of decades, it suppresses long-term economic growth.
So where are the opportunities right now? You have what, $2.25 billion in asset under management?
Lower beta and a little less octane side of things. Procter & Gamble, Johnson & Johnson, Verizon. These are companies that have incredible business models and are very, very defensive and have very superlative free cash flows, and they've grown the dividends for decades. In Procter & Gamble's case, you're talking about 60, 70 years. Johnson & Johnson's not far behind.
All right, we'll leave it there. David Bahnsen, really appreciate you joining us. Thanks so much.
Thank you for having me.